I've talked to rich men who went broke and broke men who quietly got rich. I've watched markets soar until they looked like the laws of physics had been suspended. And I've watched them fall so hard that the whole country thought it was finished. And here's what I know. With absolute certainty, after all of it, nobody told you the truth about money. Not your teachers, not your professors, not the HR department that handed you your first job offer with a proud smile and a handshake. They taught you how to earn a salary. They told you to work hard, and they absolutely positively did not tell you that the salary, no matter how large you made it, had a ceiling built right into it. A mathematical ceiling that no amount of effort will ever break through. They didn't explain what was quietly happening to your cash savings every single night while you slept. They didn't pull out the government's own rulebook and say, hey, look at this. Look at what the tax code actually rewards and what it punishes. And they certainly never told you that the thing most people call safe, the thing they spend their whole lives chasing, is actually one of the most expensive financial strategies a person can make. Today, I'm going to tell you 4 hard truths about money. The kind that universities, employers, and frankly, the whole system has a quiet institutional interest in keeping out of the curriculum. And here's what's remarkable about all 4 of them. None of this is complicated. You don't need an MBA. You don't need a Bloomberg terminal or a brokerage license. You need about 25 minutes and the willingness to hear something that runs against almost everything you were ever taught. Stay with me. Now, before we go any further, who am I to tell you any of this? Fair question. I watched the Depression hollow out families who did everything right. Honest, hardworking people. People who saved their money, kept it in banks, and trusted the institutions around them to protect it. The institutions didn't protect it. I've been through 10 recessions. I watched Black Monday in 1987 when the market dropped 22% in a single trading day and the phones wouldn't stop ringing. I watched the dot-com bubble inflate until it looked like reality had been repealed, and I watched it burst. And in 2008, when every major bank was in free fall and the newspapers were printing the word collapse, people thought I'd gone crazy. They hadn't seen what I'd seen. In 35 years of investing, the most important lesson isn't about stock selection. It isn't about PE ratios or quarterly earnings calls or any of that. The most important lesson is this. The people who build real, lasting sleep well at night wealth don't outwork everybody else. They outthink everybody else. They understand how the game actually works, and they play by very different rules. Today, I want to share 4 of those rules. The ones the classroom never got around to. Truth number 1, the Howard ceiling. You know, when I was a boy in Omaha, I delivered 500 newspaper routes before school. I mowed lawns in the summer and shoveled snow in the winter. I sold chewing gum door to door. I polished golf balls and sold them back to the players who lost them. I worked every waking hour I could find. And do you know what all that effort had? A ceiling. A hard mathematical ceiling that nobody ever bothered to explain to me. That nobody explains to anyone. See, when you sell your time, your hours, your labor, your physical presence, you're operating inside what I call the hour ceiling arrangement. You get paid, work more hours, earn more dollars. Makes sense. Logical. But here's the problem with that logic. A day has 24 hours. Sleep takes 7 or 8. Family, commuting, eating, existing, that takes more. So realistically, you've got maybe 10 or 12 hours you can sell. And that's it. That's your ceiling. It doesn't matter how talented you are. It doesn't matter how disciplined you are. The clock runs out every single night, and there is nothing you or anyone else can do to add an hour 25 to the day. Not one single hour now. Here's what the wealthy understand that the working person almost never figures out. Money doesn't reward effort. Money rewards leverage. Now look, leverage is just a complicated word for a very simple idea. It means making your dollar or your skill, your idea, your capital, produce results beyond your physical presence, beyond your hours. Think about planting an oak tree. You don't stand next to it every day pulling it upward with your hands. You plant it in good soil. You give it water, and then you step back. That tree grows while you sleep, while you're having dinner with your family, while you're on vacation, while you're doing absolutely nothing. The tree doesn't require you present to do its job. That's what a stock is. That's what a business is. That's what a piece of income-producing real estate is. Charlie Munger, he would say something I loved. He'd say, "The big money is not in the buying and the selling, it's in the waiting." He was right. absolutely right. Now here's where most people go fundamentally wrong, and I want you to understand this contrast clearly, because it changes everything. The speculator, the person still stuck hard inside the hour ceiling, thinks more hustle is the answer. A second job, a third gig, selling things on the weekend, running faster on a treadmill that doesn't get any shorter. And I understand that instinct, I do. It feels productive, it feels responsible, but you cannot outwork a mathematical ceiling. You can't. The investor, the fortress builder, takes that same discipline and deploys it differently. Instead of selling more hours, the investor plants things, buys ownership stakes in businesses that earn money without requiring their presence every moment of every day. The salary becomes seed capital. The seed capital becomes a portfolio. The portfolio, given time, becomes a machine that generates income whether you showed up today or not. That's the shift. From employee logic to investor logic. Think about it this way. Your salary is a shovel, a good shovel, a necessary tool, but you're not meant to carry that shovel forever. You're meant to use it to dig the foundation of something that eventually stands on its own. Once the fortress has walls, once the moat is full, the drawbridge is working, the armor is in place, you don't need the shovel anymore. The fortress defends itself. That's the hour's ceiling. Recognize it, respect it. Then start building above it. Truth Munger 2, the hidden blueprint, all right? Now here's something that surprised even me when I truly sat down and studied it. The tax code is not random. I know. You look at a tax return and it looks like it was drafted during an earthquake, pure chaos. But underneath all those forms and line numbers and deductions, there's a philosophy, a reward system, a hidden blueprint, and almost nobody in school ever explains it. Here's what I want you to understand. The government is not trying to punish you for accumulating wealth. I know it can feel that way sometimes, but stay with me on this, because the truth is actually far more useful. The tax code was built to guide behavior. Specifically, it rewards the deployment of capital, the act of investment, business ownership, productive asset creation, and it punishes, relatively speaking, the simple act of trading your hours for a paycheck. What does that mean in practice? Wages, your W-2 income, your salary, the check you get every 2 weeks is the most heavily taxed income that exists in this country. You earn $1. By the time federal income taxes, state taxes, Social Security, and Medicare are finished, you might walk away with 60 cents. Maybe 65 if it's a good year. But investment income, long-term capital gains, qualified dividends from businesses you own, the rate drops dramatically. For many middle-income earners in America, the long-term capital gains rate is 15%. On income from assets you've held for over a year. My teacher, Benjamin Graham, the greatest investor educator who ever lived, the man who wrote The Intelligent Investor, he called the market a voting machine in the short run and a weighing machine in the long run. The tax code operates the same way. In the long run, it weighs ownership far more favorably than labor, far more. Now, and I want to be crystal clear on this, nothing I say here is tax advice. I'll remind you of that properly before we're finished today. Every situation is different. Consult a qualified professional. But the principle I'm pointing at? Think of the tax code as a treasure map. Most people never open the map. They wander around working extraordinarily hard, hitting invisible walls, wondering why they can't seem to get ahead. But the map is public record, freely available. Anyone can read it, and it says, plain as day, in the language of incentives, we reward people who deploy capital, we reward people who invest, we reward people who own productive assets that create economic activity. I call this the hidden blueprint, not because it's secret, but because nobody in school ever pulls it out and walks you through it. The strategic goal, the fortress builder's goal, is to convert as much salary as possible over time, from the labor column to the capital column. Not overnight, not recklessly. We are patient people here. We plant oak trees and we wait for them to grow. But year by year, dollar by dollar, deploy capital, buy businesses, buy fractional ownership in great companies through low-cost index funds, own something the hidden blueprint rewards. The map is right there. Follow it. Truth number 3. The silent confiscator. You know, the question I get most often, probably once a week for 60 years, is some version of, where's the safest place to put my money? And when people ask that, what they mean is, Where can I put it where nothing bad will ever happen to it? They picture a bank vault, steel walls, combination lock, solid, immovable. And here's what they don't realize, that vault is leaking. Every single day, I call this the silent confiscator. And I say silent deliberately because this is not the kind of threat that comes with a warning label. It doesn't look dangerous. It doesn't feel like a loss. You check your account balance on Monday, and the number is exactly what it was on Friday, but in terms of what that number can actually buy you, less, a little less every single day. I'm talking about inflation now. Before you tune out thinking you've heard this before, hold on, because what most people understand about inflation is only half of it. Yes, prices rise. Your grocery bill goes up, gas goes up. The cup of coffee that cost 50 cents in my early years now costs more than I'd care to say out loud. But here's what almost nobody explains. Inflation is a transfer mechanism. It picks a winner and a loser every single year and moves value from one group to the other. Silently, without announcement, without anyone calling to tell you it happened, the loser, the person sitting in cash, the person with a savings account earning 0.4% while inflation runs at 4%, 5%, or higher. They wake up every January 1st slightly poorer than they were the January before, and they don't feel it. That's the silent part. The winner, the person who owns productive assets. Here's why. When inflation hits, when that wave of rising prices moves through the economy, asset prices move first. Real estate values climb. Equities reprice upward as companies raise their prices and grow their revenues. The business owner, the shareholder, they ride the wave. The wage earner, wages are what economists call sticky. They don't move fast. They lag behind, sometimes months, sometimes years. So for a significant stretch of time, a worker is earning the same paycheck that buys measurably less at the checkout line. Same number on the check, less power behind it. I've watched this play out across multiple periods of high inflation throughout my life. I've watched families who saved diligently $20,000 in the savings account watch their nest egg's real purchasing power get quietly eaten alive over a decade. No single dramatic loss, no alarming headline, just a slow, invisible drain. Every day. Now I want to address something directly because I know where some of your minds are going. When people hear about inflation eating their cash, the temptation is to reach for something exotic, gold perhaps, or something newer and louder. Some of you are thinking Bitcoin, some digital token, an inflation hedge they call it. Let me be plain, I called Bitcoin rat poison years ago. That position has not changed, not by a single inch. These instruments that produce nothing, no dividends, no earnings, no moat, no competitive advantage, no underlying business. They are speculative instruments dressed up in inflation hedge clothing. There's no there. No there. The real time-tested, battle-hardened defense against the silent confiscator is this. Own productive assets, pieces of businesses that earn money, raise their prices, and pass those rising earnings on to the people who own them. Companies with genuine moat. Companies with pricing power. Companies like Coca-Cola, which can raise the price of a can of soda when inflation hits and still sell billions upon billions of them. The earnings climb, the dividend climbs. The silent confiscator finds no purchase on that fortress wall. That's the armor, not a vault. Armor, active, earning, growing. Cash has its place. I keep dry powder always. It's ammunition. It gives you options, gives you the ability to act with full force when the right opportunity arrives. But cash held as a primary saving strategy isn't a safe haven. It's a slow drain. Convert your idle cash, gradually, patiently, intelligently, into productive ownership. Start wherever you can. Just start. Truth number 4. The comfort trap. Now we're at the one that I believe causes the most long-term damage, the most long-term confusion, the one that looks the most reasonable from the outside and is the most quietly destructive on the inside. Your gut is going to push back on what I'm about to say. I expect it to. Safety, the kind of safety most people spend their entire financial lives chasing, is actually one of the most expensive strategies available. I know how that sounds, but hear me out. When most people think about managing money responsibly, they think, keep it safe. Don't lose anything. Keep it conservative. They put their 401k into the most stable option available. Bonds, stable value funds, low volatility. They avoid the stock market entirely because it moves up and down, and that movement makes them uncomfortable. And on the surface, that looks prudent, careful, responsible. But here's the thing about feeling safe. It does not mean you're safe. I'll argue, and I've argued this for 35 years, that the single largest financial risk facing most ordinary people has nothing to do with market crashes, has nothing to do with recessions. The single largest risk is insufficient long-term growth. Think about what that means. If you need your money to compound at 7% annually over 30 years to reach financial independence, and your conservative portfolio produces 2%, you don't fall a little short, you miss entirely. The gap isn't a scratch, it's a canyon. And here's what's particularly brutal about the comfort trap. The discomfort of seeing your portfolio drop 20% in a downturn is immediate, visceral. Your brain registers it as danger, and your brain isn't wrong to do so. That's millions of years of hardwired survival instinct doing exactly what it was designed to do. But the slow, painless, invisible failure of compounding at 2% instead of 7%, you don't feel that. Not at all. Not until retirement, when the math simply doesn't work. The comfort trap is dangerous precisely because it never hurts, right up until the moment it does. Now, here's the distinction that is the absolute bedrock of everything I believe about investing. I want you to really hear this one. Volatility is not the same thing as risk. Write that down if you have to. Volatility is temporary price movement. The market goes up, the market goes down, and the investor who has studied real history, not just the last 2 nervous years of it, but a full century's worth, understands that the recoveries always come. Always. Real risk is permanent loss of capital. A company going bankrupt, a wildly speculative position zeroing out completely. That is risk. That is the thing worth fearing. But a wonderful business, one with a genuine moat, consistent earnings, a durable competitive advantage, dropping 30% in a recession? That is not risk. That is a sale. And here's where the speculator and the investor diverge so completely it's hard to describe. The speculator sees that 30% drop and his stomach tightens. He sells. He locks in the permanent loss. Then he waits for things to feel safer before getting back in, which usually means buying back at higher prices after the recovery is already done. He buys high and sells low, and he does it while genuinely believing he's being rational. Rational, the investor, the person who has built the psychological fortress, the wall of rational thinking standing between them and their own worst impulses, looks at that same 30% drop and feels something very different. Calm, not recklessness, not indifference. Calm because they know what they own. They understand the underlying business. They know it'll still be operating in 10 years. Still earning, still compounding. I remember when the dot-com bubble burst. Every technology holding in America was in freefall. People called me, wrote to me, convinced we had to do something, trade, hedge, get out. We stayed calm, slept like babies, because the businesses inside our fortress weren't the problem. The market's mood was the problem. And moods change. They always change. Same in 2008, when it was genuinely unclear how bad it would get. We stayed, we bought more. Because temporary volatility in a wonderful business is not destruction. It's opportunity. So what do you do about the comfort trap? Accept short-term discomfort as the entry fee for long-term security. That's the trade, that's the deal. Put your money in great businesses, diversified, quality businesses, low-cost index funds if you're not a full-time analyst, and let market volatility wash over you without doing anything foolish. Accept that some years the numbers will fall. Don't sell, don't panic, don't check the balance every hour. Build your fortress wall a little higher each month. Let the compounding math do what only time allows it to do. The person who does this consistently, who resists the comfort trap and holds steady through discomfort, builds something extraordinary over 20 or 30 years. Something genuinely extraordinary. The person who chases comfort above everything else, they're very comfortable, right up until retirement, when the math simply doesn't add up. So let me bring these 4 truths together, because individually, each one is significant. Together, they form something more than the sum of their parts. A compass. A real set of directions to the thing most people spend their entire working lives looking for and never quite finding. Financial independence. The real kind. The kind where you choose how you spend your days, not because you have to be somewhere, but because you want to be. Truth number one told you that your time has a ceiling, and that real wealth lives above that ceiling through ownership, through leverage, through planting things that grow while you sleep. Truth number two showed you that the tax code is not chaos, it's a blueprint with arrows on it, pointing straight at capital deployment. Every dollar you shift from the labor column to the capital column is a step in the direction the system itself was designed to reward. Truth number three revealed the silent confiscator, the quiet wealth transfer happening every year from holders of idle cash to owners of productive assets. You don't fight it by hiding from it. You fight it by owning things that benefit from it. And truth number four, the comfort trap, showed you the hidden cost of feeling safe. Real security doesn't come from avoiding short-term discomfort. It comes from accepting it in exchange for the extraordinary power of long-term compounding. Here's what I need you to understand about all four of these truths. They require no advanced degree, no special contacts, no inheritance. What they require is a shift from employee logic, earn, spend, repeat, to investor logic, earn, deploy, own, wait. Simple to describe, it takes years to fully execute, and the vast majority of people never make it. Not because they lack intelligence, because the world around them, school, advertising, consumer culture, the relentless noise of modern life pushes them hard in the opposite direction. Spend more, borrow more, stay comfortable, stay on the treadmill. The fortress builders do the opposite. They spend less than they earn, always, without exception. They invest the difference patiently, without chasing hype, without chasing whatever digital coin has a dog on it this week. They avoid debt that doesn't build ownership. They hold through downturns, and they repeat. The market transfers money from the impatient to the patient. I've said that before. I'll say it again, because it's the core operating truth of everything we discuss on this channel. The system you were handed wasn't designed to make you wealthy. It was designed to function, to keep the engine running. There's nothing wrong with working inside it. Work hard, build your skills, earn that paycheck. But the moment that paycheck arrives, make one decision the system never taught you to make. Own something with it. Start wherever you are, whatever you have. My partner Charlie Munger's most powerful insight wasn't about stock selection. It was about the compounding effect of right behaviors, practiced without interruption, across decades. Decades. You don't need to be clever. You don't need to time the market. You don't need to find the next big thing before anyone else. Patience and repetition. Patience and repetition. I've watched ordinary people, no connections, no inheritance, no lucky break, build genuine financial fortresses over 30 and 40 years. Not because they were extraordinary, because they understood these truths and they acted on them quietly, consistently, without stopping. That's available to you, starting today. Before we close, something important. Everything shared on this channel is for educational and entertainment purposes only. I am not your financial advisor. I'm not your tax advisor. Please consult qualified professionals before making any financial decisions. Individual situations vary. Nothing here constitutes personalized financial advice of any kind. Look, every video we put out here at Elite Money Mindset has one goal: not to excite you, not to promise you overnight returns or make your pulse race with some hot tip. The goal is to help you sleep well at night, because that's what a real financial fortress does. It doesn't promise you'll get rich by Tuesday. It doesn't promise you'll beat the market this quarter. It promises something better, quieter, more permanent. It promises that when the market crashes, and it will, your foundation doesn't shake. That when inflation runs hot, and it will, your productive assets ride that wave instead of drowning beneath it. That when everyone around you panics, and they will, you'll be the one sitting calmly, looking for opportunity. That's what we build here, together, a psychological fortress. A wall of rational thinking between you and every financial panic the world tries to aim at you. If these four truths shifted something for you today, if one of them opened a door that's been closed, please do one thing before you leave. Hit the like button. And if you haven't already, subscribe to Gaffer Wealth Mindset. We're here every week with the same mission. Quiet, patient, rational wealth building for people who are done with the noise. We're not chasing hype here. We're building something that lasts. Sleep well and keep building your fortress.